Hello, this is Richard Pawson for the Pawson Report, and this is a brief video update of the super cycles of interest rates, and if we have time, we'll include something on inflation. It is January 21st, 2014. Okay, let's take a look at this line chart of interest rates. Now, this is a AAA type commercial bond. It does adjust over time for ratings. I think the most recent update of interest rates were linked with Moody's A and then small AAA bonds. At any rate, let's look at the rate of this. We can see the rates topped around 1814, the year of, and our analysis suggests there's a 216-year cycle top during the 1810s for things like the dollar, commodity indexes, a variety of individual commodities. There was a climate problem in 1816 that caused winter for every single month, even during the summer in the U.S. A lot of crazy activity, and of course the War of 1812, but there was also a peak for interest rates, the economy, and there was a corresponding peak for the stock market, but the stock market didn't decline as fast as the economy and was able to snap back up for a late peak around 1835, and there's a few individual commodities in the 1820s, like gold, I believe, topped at that time. But you can see at any rate, we believe it put in 27-year and 54-year cycle tops, the 54 being the famous Kondratiev cycle. And you can see this nice upside down U or V pattern, cycle top to top for 27. Here's another 27, but it was truncated. Couldn't go as high as it went from a lesser important cycle. And you might say, well, it's not working. But notice how it just sat there until it met the requirements of a 27 and 54-year cycle, and then notice it sped down. And you'll see cyclical behavior like this. When the cycle's not working in some characteristic, when it's finally time to reverse, look out, it can speed up or speed down. Greater volatility. So then we get another 27-year cycle top, okay? And you can see this one is just very low volatility. It doesn't work very well, okay? Now we can get another 27-year cycle. It still has this upside down UV shape, all right? And we combine two of them and we get the more important 54, and you can see that far more clear. This is the 54-year Kondratiev cycle top to top, okay? Then it comes down and the 27-year cycle works by even a lesser degree, okay? You could say it didn't work. I have no quarrel with that. I'm not suggesting they work 100% of the time. What I do find is the longer the cycle, the more likely it does that they will work 100% of the time. But the problem is, can anyone invest that way? Probably not, because it can get beyond one's lifetime. So it's really how you manage managing your country, and maybe a super long-term business plan might be involved in these really large cycles. But what I want to point out is when these very large cycles are due within a matter of a few years or within a decade or two, they can have an increasing impact or some kind of increase of characteristic related to them, okay? So they become more important, even for those only interested in trading, say, during the year, okay? At any rate, we can see it rallied up, spent 90% or more of its time in a cyclical bull market of interest rates, exploded right into the peak of 1980, and basically 27-year and 54-year cycle tops again. Now the market comes down, rallies into a 9-year cycle top inside of a 27-year cycle top right around 2008, and then we can see it plummets on into 2012, but by 2013, rates had snapped back up as if we found some kind of a bottom. So let's study the bottoms now, and we find we have a 36-year cycle. So the interest rate model is similar to the commodity model. 36-year bottom, 27-year top. 72-year bottom, 54-year Kondratiev top. Kondratiev doesn't work for the bottom, okay? But they all merge to a 216-year cycle, top and bottom. Okay, so what we've got is another 36-year cycle bottom coming in here, okay? And it also bottoms at a 72-year cycle around 1946, I believe, and that's probably a 216-year cycle bottom, okay? So then we get this major bull market, a big bang of interest rates out of those super cycles. But now it's coming back down. Now here's the tricky part. We do not find evidence of a 36-year cycle halfway or thereabouts. The best I can come up with is this little correction right here was a sign of a 36-year cycle. I believe the market was so intense that it just had a focus on the next larger cycle that was more dominant. It didn't work. So if you want to say, okay, can't trust it all the time, I fully understand. but I believe it was there or somewhere's on the way up. Maybe if we studied day-to-day interest rate fluctuations, we could find some evidence, but it would still be classified as a near non-event. So basically, we're looking at a 72-year cycle, upside down, perfect V formation. Okay? All right. So, have interest rates bottomed for a 72-year cycle? Well, I'm concerned they have not. Okay? Because just as it's difficult to locate the 36-year cycle, I should be able to locate 8, 9-year cycles. Okay, and you can even have an extra one thrown in there, especially if it's around wartime and the government's managing things, and that's what exactly happened. That's why I bought in 1946 instead of the 1930s. We manipulated interest rates lower, and it had to do with the war, basically, in my opinion, and distorted the cycle a bit. We have the statistic. It's no longer an anomaly. We allow it. But I think odds favor it actually is an anomaly. We're probably only going to see 4 9-year cycles. Okay, so we're missing a 9-year cycle bottom. The market's probably rallied from a 9-year cycle bottom in 2012, but it's only the 7th one out of 8. We're lacking an 8th. All right, so best forecast is that interest rates can rally in line with the economy forecast, which is suggesting growing global and U.S. economies until 2017-2019, then a recession. This is in line with the stock market forecast, separate, saying rising stock market to 2017-2019, then a bear market. But it won't be a crash or burn. We're going to have a normal recession for a change. Okay? We're just going to ease things back a bit. All right, now that also coincides with our commodity research, and actually I think interest rates have a positive correlation to inflation and to commodities. So basically, interest rates should rally. Economy's growing. Things are going to cost more. We're going to put inflation up there. We're going to do more business. Banks want to make more money. There'll be more demand for money. We'll get it. They will get it. Let's put it that, or we'll get it in the sense of paying higher interest rates. Now, the problem is by the end of this decade, we should see a 9-year cycle bottom, plus a 36, plus a 72-year cycle. The interest rates are running on a decade or so later than the 2009 72-year cycle economy bottom for the economy and the stock market, and 2 decades behind the 72-year cycle for commodities. And all I can tell you is it's a good thing that those 3 have split up. And the dollar is more like the interest rates, by the way. So the dollar can put a super cycle bottom in later this decade. All right. But I'm concerned the dollar will put in a truncated bottom. We've seen as low as it's going to go. At any rate, it's a good thing they were broken up and that we're running a diversified economy. That helps shelter us and protect us in the 2009 crash. Otherwise, everything would have crashed like the 1930s. And I do believe the bailouts and the Fed work and whatnot actually assist to shelter us here, restrict things, manage things. At any rate, it shouldn't surprise us. We're going to see this rate move up to 5%. I don't know, maybe it can do better than that, 5.5%. I seriously doubt it will breach this 27-year cycle. But it may get that high. And then when it comes down, relative to higher it goes in the next few years, then the least amount it'll probably pull back. In other words, there's a chance that the super cycle bottom due towards the end of this decade will be a higher bottom than what we've seen in 2012, even though it's a less important cycle. It is allowed to be so with any cycle structure, so long as it makes some kind of attempt to retrace it, some kind of like we just call them a truncated bottom. It should come near the previous bottom. In addition, what if we were to overreact and say, oh, we have a recession going, now we got to save ourselves or turn into a great recession? What if we overreacted and put interest rates lower than necessary to stop the recession? But at least we would have increased the odds of stopping the recession, containing it, right? So the point is we can have a lower interest rate than 2012. If you look at just the most simplest cyclical structure, the idea of forecast would be still lower rates. But when you throw everything in that we have known today, the economy, the condition of the economy, the markets, okay, in my opinion, there is no reason to have lower rates than we've seen in 2012. So, on one hand, if you believe in that, then you might better say you're already a super bull for interest rates. If you don't believe in that, then you want to wait until we see at the end of this recession what happens to rates. They may only dip a little. They may come down quite a bit. They may make a new low. They may make a double bottom. They may make a little higher truncated bottom. But looking out to 2020s, we should be in a trend of higher rates, and I see a better economy in the 2020s, so it can be faster paced, higher rates. And then I think by the 2030s, we're going to have high inflation, and I think you'll then see rates speed up to keep up with that, and we may even push the rates even faster still to actually kill inflation like we did in 1980. Therefore, cyclical history again, it repeats. Okay, now what has been our next 20-year forecast? Basically, from now into the 2030s, next 20 years, we anticipate growing economy, higher commodity prices, higher inflation, higher real estate. Why wouldn't you have higher interest rates to keep up with that? Now, one little thing I want to throw in is I do not believe that interest rates are going as high as 1980 or higher, but the cycles allow it. The structure's there. But when we use all of the model analysis, my guess is we're going to manage things differently and better, and we will not see interest rates as high as 1980 or higher. Therefore, we also won't see inflation that higher. But we can and that leaves the door open maybe for even better economy, better stock market, but still a good super cycle bull market for commodities, maybe even better. So something else to consider. All right, so our best forecast is we've got this loop here for this 27-year cycle. Okay, zoom all the way out here again. And just as we've seen these two 27-year cycles, history is going to repeat or somewhat. Now, this time around, you can see this 27-year cycle didn't really work. This one didn't really work. This one didn't work, but at least better than the others. And then this one worked very well. What's going on is they're fitting inside a more stronger, more dominant 54-year Kondrativ. It is time to not only rally interest rates, albeit again, we may have to have that pullback for that super cycle bottom by the end of this decade, but it's time to rally interest rates into a 54-year Kondrativ cycle top and probably a 216-year cycle top right along with all the other markets. So indeed, just as we've had an intense minimum variation trend up and in a major bear market, we can have a fairly aggressive bull market for interest rates over the next 20 years. But I do not see from now into next decade, I do not see interest rates exploding to 13% in a matter of few years like some people want to forecast, and they want to scare us that that'll then crash and burn the economy and the stock market. Don't see it. I don't see any hyper bull market in interest rates. Don't see any hyperinflation. Okay. So that's the forecast that, yes, this forecast of interest rates is right in line with what we're forecasting in the stock market economy. Now, this is inflation, and we find 72-year, 36-year cycle bottoms for inflation. That's probably because it's highly related to commodities still, even though we're slowly evolving away from commodities in our inflation calculations, okay? But the same model, and we even think the economy runs the same model anyways. So the bottom line is probably a 27-year cycle top a few years ago, right in line with commodities, 2008, with a major important top for corn and energy prices and many other markets. Pulled back for the financial crisis, a collapse, a crash, right into the 36, 72-year cycles, which allow for such calamities. But we managed it better than any time before still. And now it's just time to rally, and someday, yes, inflation probably is going back to 10% in the 2030s, but I do not believe it's going higher than 1980. I think we'll manage it differently. I think it's going to be a slower rise, but we can have rising inflation from this cyclical structure, or I should say reflecting or relative. The cycles are actually reflecting how we're doing business here in a repetitive manner. At any rate, I hope this has been some assistance to you. At any rate, yes, even though I realize interest rates could come all the way back down by the end of this decade, I think it'll only be a retracement, truncated bottom, still higher in 2020s and a faster pace higher than this decade. Then even still faster in the 2030s, and we may even use it to kill inflation. I do not see new record highs of interest rate or inflation for this country. But indeed, the next 20-year forecast can be right that everything but bond prices is probably going up. Thank you.